Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Brandon Fontaine. Brandon is a research associate who works with the economics and fixed income research teams at Strategas. Brandon, how are you doing today?
Doing great, Ross. How about yourself?
Doing really well. Thrilled to talk to you and timely as well. We just this morning got a new manufacturing PMI reading. It was quite weak, so I'm going to turn the floor over to you to kind of detail what you saw from that and what you think is important coming out of that.
Yeah, thank you. So we came in at 46.8, noticeably weaker than last month and really below most of the consensus estimates on the street going into today. And what drove that? Four of the five contributors to the headline PMI were contributed negatively this month. That was new orders, inventories, production, and employment. The only positive contributor was supply deliveries, and the positive reading in supply deliveries means that supply delivery times actually lengthened. And I think we'll come back to that a bit later. The weakness we saw today was foreshadowed by our proprietary SLIM survey, which recorded a sharp drop into contraction earlier this month. And we also saw weakness in the regional Fed manufacturing surveys as well. We like to follow a composite of the new orders of that. That was particularly weak, and that notes that you might see some weakness in manufacturing production in July as well.
Right. And that all kind of lumps in with this overall weakness we're seeing a little bit in the labor market. The Fed kept rates on hold today. Higher rates are a big weight on manufacturing and cyclical sectors in particular. So maybe this shouldn't be all that surprising. You have noted in the past, how well or how much this correlates with earnings for the broader equity market. Could you talk a little bit about that and what this might imply for equity earnings?
Yeah, of course. So I'll leave the real bones of the earnings to my colleagues, but what I will say is the manufacturing PMI tends to be a fairly strong leading indicator for earnings, both domestically and internationally. Now, why is that on the domestic front? Well, manufacturing doesn't account for a large portion of the US economy, but it is responsible for a large share of the volatility in earnings. We see about a 77% correlation when we lead the ISM by 6 months versus S&P 1500 earnings, along with some strong correlations on the sector level with industrials, energy, materials, consumer discretionary, and healthcare. On the international front, the ISM survey actually doesn't ask panelists to differentiate between business in the US and business overseas. So you pick up on overseas activity, and there's a fairly strong correlation with European, Canadian, and Australian earnings as well.
Yeah, so we're in the middle of an earnings season right now. By all accounts, things are going pretty well, but this manufacturing PMI reading does, portend potential weakness on the horizon to at least keep an eye out for. Circling back to the top, you mentioned supplier deliveries and overall kind of supply chain. We've become very attuned to supply chains over the past 4 years with the COVID disruptions, some of the geopolitical disruptions. I wondered if you could expand a little bit about what you're seeing in that world and how that might impact inflation for goods in particular going forward.
Yeah, so that's a great question. It's one we're getting a lot because you see freight rates surging, and that brings back memories of the depths of the supply chain crisis. And when we try to model out core goods inflation, we find that really you need all the components increasing in order to see an uptick there. So when we model it out, we look at freight rates, we look at the ISM supply deliveries index, we look at auto prices, and we look at oil prices. Now, for the past couple of years, the ISM supply deliveries index has remained in contraction. You did jump back into expansion, meaning faster delivery times this past month. Our SLIM survey supply delivery index showed delivery times quicken but at a slower pace, though we are still in contraction. That being said, you haven't seen a large enough increase in supply delivery times yet to really cause us some concern on the goods inflation front, particularly as oil prices and used auto prices remain tame. So we haven't really seen all the components necessary yet for an increase in core goods inflation. And in terms of just specifically on supply deliveries, firms appear to have been able to go around the Red Sea and avoid some bottlenecks there, and you've gotten a solid rainy season out of the Panama Canal, and that has helped supply delivery times there as well. So while you've had some concerns, these concerns really haven't materialized yet.
Yeah, something to keep an eye on to be sure. As we're talking, geopolitical tensions are kind of flaring up in the Middle East again. But as you mentioned, some other, options for good shipments. So we'll keep an eye on it. We'll talk to you again soon to get the update there. But Brandon, thank you so much for the time today. Really insightful stuff.
Thank you, Ross. Have a great day.
You too.